Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, my name is Ryan and I am a mortgage nerd. I'm with Patriot Home Mortgage here in St. George, Utah. I do lending in the states of Utah and Nevada. I'd love an opportunity to work with you if you're looking to purchase a home, if you're looking to refinance, a home equity line of credit. We do a ton of different loans. We do help investors, first-time home buyers. I've been doing this for a long time. I started my career in 1999, and I just love working in the mortgage industry. And one of the common questions I get is, what are the closing fees? What are the total cost to get a mortgage? And so today I thought I'd break down the form that we call a loan estimate. This form is a standardized form, no matter what lender you're going to use, that will break down what these fees are. And there's some weight to it. We have to disclose a certain amount. We can't raise the fees. This form's replaced the old good faith estimates. GFEs is what they used to be called. We're now all called loan estimates that are all standardized for every mortgage company. So today I wanted to break down what to expect, some of the fees, what boxes they're in, what to look for as you're working through maybe your own loan estimate. Maybe you got a loan estimate from a mortgage company and you just kind of want to know what some of this stuff means. So today I wanted to break down that specific form. So let's jump on to slide number 1 here. Kind of our topic for today is mortgage closing costs, the loan estimate. We're going to talk about what prepaids and escrow accounts are. And then we're going to talk about loan fees, the actual fees associated with the mortgage. So let's go to slide 2. Yep. Good job. So this is the first page of the actual loan estimate. This is going to break down some of the one-page sheet. It'll just show you kind of your interest rate, your loan amount, your money you need to bring to closing, just all in one easy first page of the summary here. So let's break down each section and kind of what's in each box. Let's go to slide 3. The top of this is going to show you your name. It's going to show you the property address, the sales price. It's going to tell you with these boxes on here what type of loan it is, whether it's FHA, VA, conventional. It'll also tell you whether the interest rate is locking or floating. So when it's locked, it has a certain time frame of when that interest rate is good for, regardless of what happens with the market, up or down. Now, typically, if the rates really go down, lenders do allow you to float down the interest rate. But generally, once it's locked, you have that interest rate that time period with the loan. So then the top of this is going to have the loan amount. This will be what we're actually loaning, at what interest rate, and whether or not that loan is going to have a balloon payment or a prepayment penalty as a quick, easy yes or no. It's going to be right there on the form, so it's not in legalese or fine print or anything like that. Does it have a prepayment penalty? Yes or no. Does it have a balloon payment? Yes or no. If it does say yes, that box opens up and explains when the prepayment kicks in, how much it's going to be. But most of the loans we do now don't have prepayment penalties. They used to be very common years back. They might start to come back in the future, but as of now, it's very rare. But this will very specifically say whether it has that feature with that mortgage loan. And then you'll also see any adjustments to the rate at that particular point. All right, let's go to the next screen. The next screen is going to break down what the payment total is going to be and how long that payment's going to stay the same. Now, in this scenario, I did a $450,000 purchase with 5% down. So in this scenario, there is mortgage insurance. And on conventional loans, it can drop off after 5 years, but not longer than 10 years. So the form requires that we put on kind of the worst case of the mortgage insurance. So you can see on the form for the first 10 years, this is the payment with the mortgage insurance. After 10 years, the mortgage insurance drops off, but the principal and interest stays the same. You'll also see that if this loan includes an escrow account. Escrow accounts are for the taxes and insurance. So when you buy a home, you're going to have the principal and interest on the loan itself, just like a car loan, like any other loan. But a lot of mortgage people or people that have a mortgage, they will include the taxes and insurance as part of their monthly payment. So when you make your mortgage payment, you also cover the homeowner's insurance and cover the property taxes. Here in Utah, the taxes are due in November. So it's very common to see an escrow account in Utah because it's only once a month, kind of right around the holidays. It's just easier to take the taxes, divide it by 12, add that to your payment. There's no fee for that. There's no charge for that escrow account. It's really a service the mortgage companies add to make sure those two extra expenses are also covered because they want to see that the insurance is on there. They want to make sure the property or taxes are paid. So including that as part of the payment is very, very normal in Utah. Also on this form, you're going to see the total summary of what to bring to closing. It'll have right on the bottom, this is what you're expected to bring to closing if all these numbers are right down to the penny. And we'll talk about that here in a moment. Some of these can change and adjust based on the day you close and things like that. But based on the time or the numbers this loan estimate was based on, this is the short to close. This is all the closing costs and your down payment right on the front page. So you have your payment, how much you're borrowing, and how much you have to bring to closing right on the first page of the loan estimate. All right, let's go to page number 2. This is an itemization of all the fees that are carried over to that first page. You'll see sections A all the way through J, and each one of them has a certain criteria of what goes in that box. So regardless of what it's called, it has to go into a category. That category determines what we call it. And so we'll go through that. So let's kind of zoom in here. Let's go to the next slide. This will zoom into sections A and B on the second page. This is where you have the loan cost from the mortgage company itself. So this is where you're going to see the most differences between mortgage companies. We all get the money from the same sources. We all follow Fannie, Freddie, FHA guidelines. It's not like they're any different for any different mortgage company, and the market determines the interest rates more than anything else. But loan fees, as far as what's charged, this is the section you'll see some differences. Whether they charge one lump fee for everything or whether they itemize everything out, you can see examples of different fees. But regardless of what they call it, it goes in that box. So you can see a total summary of what the lender is actually charging to originate that actual loan. And then section B are appraisal and credit report fees. We have to honor those numbers we put on there. They cannot go up. So we have to honor that number, and we also cannot charge more than what the actual invoice is. So if let's say we disclose $575 for an appraisal and it's only $550, we don't get to just pocket the difference. We have to lower that amount. But vice versa. Let's say we disclose $575 and it's $600. We actually have to eat that difference. Unless there is some circumstances around it, but generally we have to eat those differences. So these sections are locked in, and we just have to make sure that we over-disclose, if anything. So we usually pad the number on the credit report a little bit because we don't know if we have to reorder a credit report. Now, I've had times where we need a cosigner, and now we have to add another credit report fee, or we have to do an updated trade line or a credit supplement or something. So we usually pad that number a little bit at the beginning until we know what the actual invoice is going to be for. So you usually see that number just a little bit higher. All right, let's go to the next screen. This is going to combine the title insurance and all the other boxes down at the bottom. So it summarizes the left hand of that second page. So title fees are what is in this box as well. They do allow up to a 10% variance. So we can, if we misquote the insurance or forget to put on some sort of fee of some kind, they do allow us to increase that by 10% as a total number. So they give us a little leeway when it's a third-party fee like a title company, because maybe there's an endorsement fee or a notary fee, or there's some other fee that's a part of it that wasn't initially disclosed. Now, all of us have been doing this a long time. We don't really mess up these fees very often. We usually get the fees from the title company before we disclose, but they do allow a little bit of cushion if there is a number that's wrong there. The most common thing that happens is, say the clients aren't in town and we have to send a notary to their home, and that fee is more than what we disclose. They do allow a little bit of a change there. Or if the loan amounts change, that goes up. But when a loan amount changes, then we can change other fees because that's a change of circumstance. That's different than what the numbers we were using. But it does give you an idea that these fees are designed to be really close. They don't want people to get disclosed, hey, your loan's going to cost only $2,000. They show up to closing and it's $15,000. They want to make sure the numbers that we disclose are really accurate. They put our feet to the fire a little bit more and say, hey, make sure you're disclosing the correct numbers. If anything, it's more encouraging us as lenders to maybe over-disclose a little bit and then bring it down as the information comes in, appraisal, homeowner's insurance, as we're gathering documentation, getting the home inspection, whatever it might be, the fees kind of get better as we go along. That's kind of what they've designed this form to do. All right, let's go back to the main page, or the next slide. This will be an overview again of page 2. Now let's break down the right side of the loan estimate. This is page 2 again. This is now the right side. This section can change no matter what it needs to change to. And I'll kind of go through that as we zoom in on some of these slides. But it's designed to be able to allow the cushion that isn't necessarily a profit center for anybody. It's just kind of how loans work. So this box allows us to change it to whatever the number needs to be. So let's go to the next slide. We'll zoom in on the top section here. This here is where you're going to have the recording fee with the county. So normally, if we have to take somebody off a title report or add a trust to the property, there's usually a fee for that to record it with the county. So they do allow us to adjust that to what it is. And we usually try to overquote that a little bit again, just to make sure the numbers are padded so we don't have a real big difference when you go to closing. Also, in some states, you're going to have what's known as transfer taxes. Here in Utah, we don't have that yet, hopefully never, but that's something that always pops up every couple of years to add transfer taxes to Utah, where in Nevada, they do have transfer taxes. So this is the box where we put that number. And a lot of times we know what that number should be or really close to what the number will be. But if we get it wrong, this box allows us to adjust that as needed. The next section is known as prepaids. So this is going to be for your homeowner's insurance. When you buy a home, you have the principal and interest on the loan itself. Then you're also going to have the homeowner's insurance, which is typically a yearly policy, and then the property taxes, which in Utah is every year in November. They're due right around the holidays. Every year they're due in November. So most people opt for an escrow account to where they take that yearly fee, divide it by 12, and just add that to their mortgage payment. There's no fee for that. There's no annual service fee or anything like that. It's just added to your payment to make sure when you make the mortgage payment, you're also covering the property taxes and insurance. So this section allows for us to calculate how much we need to put in the escrow account to start the account, prepay the first year's premium. All those are kind of built into that section of the screen. Also, you're going to have the interest for the month. So mortgages are paid in the arrears is what it's called. So when you make your payments, say for the month of January, you're actually covering the interest of December. So when you buy a home, let's say you're buying a home in December, we cover the interest from the day you close. So say it's the 15th of the month. We cover those 15 or 16 days of interest. You then have January's interest accrue. Your first payment's February 1st. So it's how that's set up that whatever day you close, whether it's a refi or a purchase, that day to the end of the month, you cover that interest up front. The interest accrues for the next month. Then you make your payment. So that's just how mortgages work. That's how they've always worked on how they collect and calculate the income or interest. And so you won't see a mortgage payment that's like just 30 days after you close. Very rarely. It's always due on the 1st of the month. It's late on the 15th of the month. That's very industry standard. There might be a few out there that will go out 30 days. Maybe second mortgages will do that. But it's very, very common just to always collect on the 1st of the month, late on the 15th, and then 30 days late when you roll into the next calendar month. So to make that work, they collect the interest of that month. And I would say most of the real estate contracts I see always have closing towards the end of the month. They just always kind of, they open up the calendar, look at it and say, we're going to close by the end of the month. So there's usually not a ton of interest that's collected up front for those days. But if you do close on the 1st of the month, then you've got to collect all of that interest. So this is where you put it on the form. So this is where you estimate based on the contract, based on when you're going to close. But that day could change. And it could be a $100 difference every single day or a $30 difference every single day. So that number can fluctuate all the way until you actually sign or at the title company. But this, again, is what the estimate's designed to do, is to kind of put on there what we think the number is going to be based on the settlement date deadline on the contract. But this form has all that built into it. Let's go to the next slide. This will be where we add all the stuff on this form, all in there as the charges. This is also where you get any of your credits. So you'll have your credit for loan amount. You'll have your credit for any deposits you've given to the builder or any deposits you've given to the seller as called earnest money deposits. That'll be credited there. If you have any seller paid closing costs. So a lot of times people will work in these costs as part of their sales price. So that's where that credit is factored, and all the credits, all the minuses, all the positives all get added up down there at the bottom to that number. So this page really just itemizes where all the money is going, so you know exactly where it's going, and it really has to go to the invoice. There's a reason for all these boxes. Now, some loans have mortgage insurance up front. Some have transfer taxes for the HOA. There's all kinds of things that can go on all these other boxes, but there's always a box for something, and that's where it ends up going, and then that's where we calculate the total short to close. So your down payment, all the fees, all the credits, bam, right there on that number. That number gets carried over to the front page, so it's right at the beginning. Very easy to see. There it is. All right, so let's go to the last page of the loan estimate. clear as mud, right? You can see that. That's part of my job is to go through all this stuff and figure out, okay, what fee goes in what box and what type of loan has a different fee, what type of loan has a different appraisal, which is a different fee, what kind of credit report do we need? Do we need flood insurance? Do we need homeowners insurance? All that type of stuff. So the final page is a breakdown of some of the features of the loan. Again, is yes and no answers, just to kind of help summarize it, try to streamline some of the other disclosures that are out there. So let's zoom in on the first section here. Let's go to the next slide. We'll zoom into the top here. And the next slide will have my information. So my loan number, or sorry, not loan number, my license number will be on there, my email address, phone number, all that stays with the file. That way, if they ever detect any kind of fraud or have any questions, or if you have questions or can't remember who your loan officer was, bam, it's right there on the loan estimate that we are just associated with that file to begin with. And that's how it works. So the next section is going to talk about whether the loan is, this is the APR. So in the next section, it's going to show you what the APR as a federal requirement of what your actual loan costs are. APR is a way to shop interest rates because everybody can advertise a certain interest rate, but if one company charges more than another, the APR is a way to kind of compare interest rates. And it's a way to compare your loan costs with that interest rate. So this section is going to disclose what that APR is. It's not the actual note rate. It's not what you're paying interest on. It's simply a disclosure to use as a comparison tool to another mortgage company. And then they added a new type of interest rate they call TIP, or total interest paid. This will show you if you make your minimum payment over the entire life of the loan, the total amount of interest that you'll pay on that loan. So they've added that to this form. It's right there in that section, the total amount paid. Let's go to the next slide. This is going to show you the other things on this form. It's going to show whether, again, there's a prepay. It's going to say whether the loan is assumable or not. It'll also tell you whether or not the loan is being serviced by the lender that's issuing the loan estimate. So it has a couple of summaries here of just some general things. All these used to be separate forms. So what they were trying to do is say, okay, let's try to combine some of these into one or two sentences, yes and no kind of thing, and bam, right there. So they're able to get rid of a lot of these other disclosures by just kind of putting it on the final page of the actual loan estimate. And then down on the bottom is your signature. But you'll see right at the top, it says this does not bind you or the lender to the terms of this estimate. By signing it, you're just acknowledging that you received a copy of it, that you understand what it is. If you have any questions, you can still ask. This is designed to be a way to make sure you're more educated going into it instead of waiting all the way to the closing table before you even know what your loan looks like. That's really the importance of this. It has a little more weight to it. We have to disclose more correctly. You can't just have a random fee that shows up without a reason unless it's in a certain category. But even then, if anything changes with those numbers, we have to reissue a new loan estimate with anything that changes. So sometimes maybe the appraisal comes in lower and adjusts the loan amount. Or sometimes there will be an HOA transfer fee we didn't know about. Or there'll be something that we have to adjust. We have to reissue that loan estimate every single time. Also, we have to issue one within 10 days of closing. So you can't get one 30 days ago and not have an updated one. Now, that's very rare. Usually you're going to have, I would say, maybe 3 of these during the process. You'll have the initial one, then you'll have one that locks the interest rate, then you'll have maybe one that just cleans up some of the final invoices before you go to closing. So I think through the process, you're going to see probably 3 of these during the process. But the idea is hopefully they get better. Like each one of them is lowering or tightening up the numbers unless there is something we didn't know about. But generally, we're trying to catch all that at the beginning and lower the numbers with every time you get a loan estimate. And then when it goes from floating to locking, you'll get another one. Now, here's the fun part. And this is all federal government came up with all this stuff. So I'm just reading what they're saying. So once you have a loan estimate, then you get what's called a closing disclosure. The closing disclosure looks very similar. It does have a couple extra pages at the end, but it's the one you actually will sign 3 days before you can go into the title company and close your loan. That one's the final disclosure. That one really can't have any major adjustments to it. Certain categories can't change at all at that point. But that one is saying, okay, here's the estimate. Here's what we're working with. Here's all the padding that we've done. Here's the locked estimate. Then you get a closing disclosure 3 days before you can go into the title company. That one you really want to pay attention to because it's the one you're going to see the actual number to bring into closing. All the padding is removed. Any changes are on that closing disclosure. We often call it a CD. We like to abbreviate everything in our industry. So we call it a CD, but You want that, and you need that 3 days before you sign. So if you're supposed to close, say, on the 5th, and they haven't issued that on the 2nd, you're not closing on the 5th. So you really want to make sure agents are really getting better at asking, hey, have you issued the closing disclosure? Have you issued that? As you're getting closer to that settlement deadline, you want to make sure that form has been issued, because we can't sign your loan until you have 3 days, 3 full days to review that disclosure, ask questions, make sure it matches what you were shown in the beginning. If it doesn't, there's that disparity. The mortgage company a lot of times have to eat those disparities depending on why there's a difference. So you want to watch for that closing disclosure, because it does come out at that 3 days before you can sign. And the days are a little bit interesting. It counts the day you sign all the way up to midnight. So you could get it after hours, you get it at 8 o'clock or whatever. That's day 1. Then you have day 2, day 3, and then you can sign. But it doesn't count federal holidays or Sunday, but can count Saturday. So that's important as you're getting closer to your settlement deadline. You want to maybe ask if that it's been issued or why it hasn't been issued. Usually there's an issue with the file. If they haven't issued a closing disclosure, that usually means the file's not approved yet, or they don't have all the numbers. There's usually an indication something's wrong if they don't issue a closing disclosure. That means the file's not ready to hit that milestone, to not be ready to send that out. But if you haven't seen it and you're trying to close, you want to make sure that there's a reason behind that and why that has not been issued. So that will have a side-by-side comparison on the form between the last loan estimate you were issued. So by lending laws, we have to show you, okay, here's what we thought it was going to be. Here's what the final numbers were. Where are the differences? That form will show it. And I would say 90% of the loan estimates now with the CDs will be less, because, again, there's all this padding kind of built in. You don't see it go up very much. And if it does, there's protections for the client that it just can't go up a crazy amount. Again, there's certain categories that can, but generally speaking, we're trying to get that loan estimate as close as we can or a little higher than the actual closing disclosure. And all of this was created from the 2008 crisis, where they felt people were getting these good faith estimates that were just garbage. I remember seeing some that were just like, there's no way. They didn't disclose the escrow account. They're just trying to make the number look as low as possible to get people way down the road. There used to be a term that I would hear that was called slam them in the booth. Just get them in the title company, get them there where they're going to lose their earnest money or whatever, and that's the loan, and just get them in the booth. Because once they're in there, they're not as likely to just, no, I don't want this loan, and walk out of the title company. It's just a horrible practice that this was designed to kind of stop that. It was designed to say, okay, there's going to be some weight to what you're disclosing. You can't just randomly come up with way lowball numbers and then hit them with all these extra fees when you actually go to the title company. You actually have to honor your fees. And we give them 3 days to look at the final numbers before they even walk into a title company. Before they even schedule, hopefully, the title company, they've gone through the fees with their loan officer. They've gone through what they're expected to bring to closing and can make any adjustments or anything that needs to happen. And usually by that point, they've already seen 2 or 3 of the loan estimates. So usually is a big surprise between the last loan estimate and the actual closing disclosure. But they're just protections. And there is a side-by-side comparison there at the end. So I hope that's helpful. That's a lot of the fees, a lot of the ways these get done. It's not all mortgage company fees. Some is title company, appraisal, credit reports. I mean, there's a lot of moving parts that all have to come together when it comes to doing a mortgage loan. And that's where I step in. I know what fees the title company is going to need. I know what fees typically the appraisers charge in the credit reports. That's my job, is to make sure that form is as accurate as possible. But I think it's just good business practice to make sure it's a little higher and just gets better as you go along. So there's times where I've had people say, well, I got this guy over here. He's $100 cheaper. Now I look at the loan estimates like, yeah, but look at what the real differences are. You can see what I'm padding in there to make sure that you're not surprised at closing with a huge, bigger invoice than what you were thinking. And so many people think that they just have to come up with their down payment. Or if it's 100% financing, they don't have to bring anything, where these fees are on top in many cases. And the best way, again, to get those covered is to include it in the sales price itself. But if you like a loan estimate, if you want to get a review, if you want me to review a loan estimate that you've received, if you have any questions about mortgages to purchase or refinance, I can help you in Utah and Nevada. I love doing your business. That's part of why I like doing these podcasts. That's why I like talking with people. I've been doing this a long time. And the reason I like it is just a problem-solving kind of business. People come to you with, I want to buy a house, or people come to you, I need to refinance, or And it's just a lot of problem solving. Come to me with your scenario. Let's walk through it, see if I can help you. If I can't, I can send you to somebody that can, or I can help you with a loan down the road. So maybe it's a credit thing. Maybe it's a down payment thing. We have all kinds of ways to get people into home financing by just knowing what's out there. But going through the loan estimate is really important because that's the final number that you have to bring to closing. So check out my website at ryanbolton.com. Check me out on YouTube. I put a lot of content on there. There's mortgage calculators on my website. You can apply right there. I'd love to talk to you about your mortgage needs. Go to ryanbolton.com, and we'll see you next time on the Clear to Close podcast.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.